All right, but we begin with this. It's not a dive, but a jump. The Federal Reserve announcing its 9th interest rate hike in the span of about a year.
Yeah, that's right. The move to combat high inflation comes amid the worst banking turmoil that the U.S. has seen in more than a decade. The Federal Reserve increased rates by 1/4 of a percentage point today.
And in addressing the recent bank failures, Fed Chair Jerome Powell emphasized the U.S. banking system is, quote, sound and resilient. He added that inflation, however, remains too high.
My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone.
Joining us now to suss this all out is our powerhouse roundtable, CBS News political correspondent Caitlin Huey-Burns, CBS News contributor and managing editor for business and markets for Axios, Javier David, and the host of the financial news website, TheStreet, J.D. Durkin. How lucky we are to have all three
Welcome,
of
folks.
you
Yes.
to help talk about what the significance of today.
This is what was expected. What should we read into how the Fed chair is navigating this banking crisis as well as inflation?
Yeah, I think the biggest thing is this meeting, besides all the other ones that came before it, really ended up shaping up to be a heavyweight battle between price stability and financial stability. And it looks to be that the price stability component won the day. We're still very much in a battle against inflation. The Fed has said ad infinitum that it is very serious about not stopping until the job is done. I think the fact that they did 25 basis points as opposed to 50 basis points, which, believe it or not, several weeks ago, that was priced in, suggests that they kind of want to slow down without stopping. So what we are seeing is them digesting all of the turmoil that's been in the market, the fact that it's not really just on them, but the government, and when I say the government, I mean Treasury and the FDIC, are also responsible for sort of taming the fears that have enveloped the banking sector and really rattled markets. But you have what is, I think everyone is just nervous that this is a repeat of 2008. And it's very important to emphasize that this is not 2008. Large banks are still very resilient, and there's just no housing bubble. And we don't have these crazy complex financial instruments that endanger the global economy.
I want to bring JD into this conversation as well. You are there on the floor of the New York Stock Exchange. And before all this happened, Errol and I were talking about our predictions. We predicted 25 basis points. Both of us got it right. But we expected that the stock market would also have their predictions. I understand that the markets have jumped with the announcement. Tell us more about why we're seeing what you're seeing right there.
Well, absolutely. Even though that was the bet largely for expectations, and I've spent the day here talking with market makers and traders and on the phone with analysts, and you're exactly right. And your prediction was correct. Congratulations to all who correctly guessed that this would be an increase of 25 basis points here. But really the more interesting number to me is the federal funds rate projection. This is a day where the Fed officials get together and they give us what's called the dot plot. That's sort of the anonymous survey of voting members of the Fed. So arguably what's more important than the hike of 25 basis points is the projection of where rates are going to go from here. And this is probably what's really moving the markets right now. It's not necessarily the top line print, but it's the fact that back in December, Fed officials said in the final analysis, when the dust settles, when all is said and done, we think the federal funds rate will be 5.1%. The concern coming into today was that Fed officials would adjust that projection to be higher, but the information we got right at 2 o'clock indicates they still have that projection set at 5.1. So if you see a little bit of a relief rally over the course of the next few hours into the end of trading today or into the next few days, that's because investors who had been really concerned that the Fed would go higher for longer are getting their first indication that increases are nearing an end. Of course, we stress the importance of not just the carefully prepared statements from Fed Chair Jay Powell, but also that really important question and answer portion where we always learn a lot more information about his intention as well as the attention of other Fed officials.
Yeah, JD, you're exactly right. Great for you to focus on that. Fed rate prediction number, also factoring into sentiment. Caitlin, to you at the White House, in the wake of what we've all been witnessing, these bank failures, you have now the Fed's decision in spite of or because of the strength of the economy, which the White House has been trying to shepherd. So how is this likely to be viewed where you are, that the Fed is continuing as expected, no surprises, but in some ways, the administration is a victim of its own success because unemployment is so low and people have money to spend to raise inflation?
Yeah, absolutely, Errol. It's a tricky balancing act here, and there are a couple of considerations. One, of course, with the overall goal of the Fed trying to tame inflation. On the other hand, you have had we're, I think, just 2 weeks away, removed from that banking crisis. So there were questions going into this about if the Fed did hit pause, what would that say about the broader banking kind of ecosystem? And that's something that's been of concern to those invested politically as well, of course. So you don't have that, which signals perhaps some strength, at least in the banking system, according to Janet Yellen, who said as much yesterday. But on the other hand, you still have this issue of inflation, trying to get prices down. And the question will be how consumers are finding this, kind of how it hits their bottom lines, whether they are reacting. There have been several increases, but over a period of time. And though this is lower than what they had originally wanted to do before, it still is an increase. So what the White House is going to say today is that, look, the Fed is an independent body. They need to do what they need to do. They're still maintaining confidence in the Fed chair. But look for some reaction on Capitol Hill to Jerome Powell's policies. Even within the Democratic Party, you've had those disagreeing with him, those thinking that he should have hit pause and not having confidence in him. So if there is a kind of growing reaction on Capitol Hill among Democrats, that could be something to watch today.
And it's important you mention things that people feel. The price of eggs, bread, milk, the staples. Everyone's seen those prices jump. And Javier, to you, these interest rate hikes are meant to cool inflation. And we just had a graph up showing that it's down from above 8% at 6%, but it's still too high for too many folks. When would you expect, based on what we now know today, that to change?
A couple of weeks ago when the Fed chair appeared at Capitol Hill, he really got the business and a bipartisan business, nonetheless, from people senators rather, who really were trying to press him on the impact of these rate hikes on ordinary people. So on the one hand, we have seen some relief, particularly in food prices and other sort of consumer staples where they have come down. But it is really important to make stress, rather, that these rate hikes have put upward pressure on all sorts of borrowing costs, loans, credit cards, and we have ample evidence that suggests that consumers are spending very heavily on credit cards in the face of they've had to sort of navigate this high price environment. So it's really important to stress that this is still a hike, nonetheless. It's less than what we expected, and it's going to put more pressure on the banks who are struggling to navigate this environment of higher interest rates like everyone else. But it's very much still on the minds of consumers that they're paying more.
Let's talk about that more pressure on the banks, because Errol, you have been reporting on this at the very forefront, standing there with people outside of Silicon Valley Bank as that bank was failing. And JD, as you're looking at this, many people prior to this announcement were saying that this decision was more pivotal than the other ones because of those bank failures. Do you believe that that's true in terms of the impact that it could have on both investors and business owners? And also, how are banks going to deal with the fact that these interest rates continue to rise? And to your point, the rate projection of 5.1 and some of these long-term mortgage rates at near 0% on their books, how are they going to reconcile this? Are you concerned? Are others concerned still?
Well, what we've seen since the last time we heard from Chairman Jay Powell is that a lot of banks right now are not very well situated to handle a high interest rate environment. And to your point, I'd like to shout out Errol's reporting because I've been watching it when he was out there outside Silicon Valley Bank talking with a lot of these people who understandably are concerned. They hear these headlines about a bank run, and I think that type of journalism and getting the story from those individual depositors is really important for context in terms of the individual viewers, right? We talk about the wonky headlines and the big picture stuff and the impact on the big corporations and the big banks. But what's most important are the actual American families who make up part of the American economy.
Right.
But during this environment of high interest rates, what we saw with banks is, hey, they got into this game of buying long-term bonds and treasuries during a low interest rate environment. And now they're sitting there stuck, knowing that the Fed was going to raise interest rates. And as we continue to see that number go higher, obviously previously issued bonds now become devalued versus newly issued bonds. And if you're going to sell those in a bond market like we saw from SVB, you're going to have to take a hit. One thing Fed officials said at 2 o'clock is that tighter credit will weigh on economic activity, but the banking system is sound and resilient. That is largely what I expect we'll continue to hear from Chairman Powell and his colleagues at the Fed to try and assuage any concerns about the volatility that we've seen out of the banking sector the last week or so.
All right. Well, J.D. Durkin, Caitlin Huey-Burns, Javier David, thank you all so much. We'll continue to monitor this and the implications for the markets. Appreciate
Thanks,
it.
everyone.
Thank you.